Thanks for joining us for our Savvy Ladies Wednesday Wisdom webinar. I'm Maggie Montemuro, and I'm the Marketing Coordinator at Savvy Ladies. A quick reminder that if you have any questions during the webinar, you can type them into the chat box. And if you're listening on your phone, please email your question to info@savvyladies.org. Today's presenters are Natalie Karp and Rona Loshak, founding partners of Karp Loshak LTC Insurance Solutions. Natalie and Rona are highly accredited, award-winning specialists in long-term care insurance and are recognized as a leading resource by the Wall Street Journal and Newsday. They help people understand LTC options with unbiased analysis and expertise. Natalie and Rona are also adjunct professors at CW Post Tax and Accounting Institute, Long Island University. Thanks so much for your time today, Natalie and Rona, and I'll hand it over to you.
Hi, my name is Rona Loshak. I will be starting the presentation. My partner, Natalie Karp, will be continuing the second half of the presentation. We're going to be speaking about why long-term care planning is so critical for women, protecting your most important assets, family, lifestyle, and independence. Long-term care is where your health insurance for acute medical conditions leave off. Long-term care is your largest unfunded risk in retirement. It threatens to disrupt assets and income as you retire and age. It means a loss of independence and dignity, and long-term care issues definitely burden your spouse and adult children if you are not protected. Long-term care challenges blended families as well as create wealth transfer conflicts if nothing is in place. Long-term care issues pressure multi-generational families with competing financial needs. Think about the fact of children needing to pay for college costs while a parent might need long-term care. Why are we uniquely qualified to be speaking about this to you today? Without going into great detail, I just want to explain that Natalie and I are licensed in over 15 states, work with every carrier and plan design and every type of plan that there is out there, including partnership plans and the life LTC plans. They all have different variables. You probably hear on the news all the time that what is going on with the long-term care with people, the growing baby boomers, the tidal wave of caregiving that is coming. In 20 years, we are going to have 2 times as many people over the age of 65 as we do now. Daughters provide 2 times as much care for aging parents as sons do. Women make up the majority of care and have reached success in their careers and family life, which may be sacrificed. Mothers, don't let your daughters grow up to be caregivers. The message being that women not only are the caregivers, but they are the ones that will be needing care as we are living longer. So it's a 2-pronged reason why women need to take ownership of this issue. The average life expectancy for women is age 88. Once a person reaches age 80, there is an 80% chance they will need long-term care in their lives. As we age, women are more likely to be living alone, more likely to fall or develop a chronic condition, may be on a reduced income, especially while maintaining a home and lifestyle, and in many cases, if the husband needed care first, he might have used up some of the retirement income, and as we age, inflation eats away at our retirement income, and we are 10 times more likely to have cognitive issues. Not very good scenario, so every person needs to know, every woman needs to know that they will be a single woman at some point in their life, either divorced, widowed, or never married. Women need to be proactive and take steps to secure protection if they are currently married. Again, even if you're not the one who is the person making the financial decisions currently, it is important that you are the one who secures protection and makes sure that you're protecting the whole family, because if your husband needs care, it will affect you and your spouse. Every woman will be a single woman at some point. If you are not in a current relationship, it is critical to protect your independence. You do not want to burden your adult children, nieces, or nephews. If a spouse is uninsurable due to health, it is even more important to get protection. Do not succumb to spousal guilt. Many people, if they're in a relationship, feel if their spouse cannot get care, then they don't want care, or they forget about care and put it to the back burner. It's even more critical for them to be protected. Women want to maintain their lifestyle and receive care in any setting. So they want to make sure that they have a separate pool of money to pay for that care and have choices. Women with blended families and grown children have a whole host of issues with caregiving and caregiving costs, especially if they are divorced or their children are divorced. Who becomes the caregiver at that point? Women do not want to burden their children or cause friction. Most children revert back to their 7-year-old selves when dealing with sibling situations. It doesn't matter how much money you have. One child's going to want to put you in the penthouse of the best assisted living. Another child's going to want to take you into their home with maybe expectations later on. And then one child's going to say, put you on Medicaid no matter what the conditions may be. So it's important to have a separate pool of money to pay for your care and have choices. Positioning for this longevity risk is critical. Don't wait for a diagnosis to plan ahead and get educated on your long-term care options. Let's talk about long-term care, the facts. Long-term care picks up where medical insurance leaves off. Long-term care refers to assistance that a person with an illness or condition needs to get through the day. The need for care is caused by a physical or cognitive impairment. LTC is care provided to help you perform the necessary activities of daily living. The activities of daily living are bathing, dressing, transferring, toileting, continence, and eating. There are 6 of them. Your doctor must determine that you will need help with 2 out of the 6 activities of daily living, or need supervision for cognitive impairment for at least 90 days to trigger your long-term care insurance benefit. These long-term care insurance benefits, these long-term care definitions were standardized with the 1996 HIPAA legislation. So no matter what plan you buy, no matter what carrier you buy, these triggers are standardized and cannot be changed. You have to distinguish these triggers from anyone who is talking about a chronic illness rider or a terminal illness rider. Those are much more narrow definitions of long-term care. How much will long-term care cost you in the future, and what kind of cost do we need to be insuring against? If you think about the fact that your lifestyle is supported by an income stream, paying for care will likely mean reallocating income in retirement or selling assets, which will adversely affect your ability to keep financial commitments. The average cost of care today, whether at home or in assisted living, nursing home, is about $100,000 a year. The average time care is needed is 3 years. In today's dollars, that equals about $300,000 for the cost of care. However, what we need to talk about is what about care costs in the future when we will need care? With the cost of care rising 5 to 8% per year, in 15 years the cost will double to $600,000, and in 30 years the cost of care will be $1.2 million per person or $2.4 million per couple. These numbers sound crazy, but as I remember, when I went to college 35 years ago, my tuition was about $2,500 a year. And they said that when we had children, it would cost about $50,000, $60,000 a year for college tuition. Those numbers sounded outrageous, and here we are today. So I urge you to take these numbers seriously. How are we going to cover those costs? There are gaps in government long-term care programs, and basically with the health care bill, Congress is saying to the public, take care of your long-term care needs with private funds, because there aren't funds available to create new entitlement programs for everyone. Long-term care insurance is a must for baby boomers since Medicaid will not be there for them, says a well-known, respected attorney in this area in the USA Today in 2014. Let's clarify what the government does and does not pay for. Medicare, Medicare supplements, and private health insurance does not pay for long-term care. Medicare, Medicare supplements, and health insurance pays for skilled care only, such as acute medical conditions with a doctor's visit or hospital stay. Custodial, supervisory, or unskilled care is out of pocket. Medicare has the ability to pay for up to 100 days of skilled nursing care. However, in most cases, just approves 20 to 25 days. Long-term care, on average, is required for 3.2 years, and for patients with Alzheimer's, the average care need is 6 years or longer. Medicaid is the government program that makes you spend down your money. Medicaid is not the Medicaid you might have thought of with your grandmother. Medicaid has been drastically cut back as health insurance has dipped into these funds. There are more state laws where assets are subject to mandatory estate recovery. Transferring assets causes tremendous issues with divorce, bankruptcy, sibling rivalry. Medicaid is a managed system now. You might not get the type of care you need. It does not pay for assisted living. It does not pay for most daycare programs. And you basically need to be bedridden to get home care. It is stretched to its limits. In addition, even if you did qualify financially, the medical triggers for Medicaid can change. So, where I told you before the medical conditions for long-term care insurance are 2 out of the 6 activities of daily living or supervision for cognitive impairment, the medical triggers for Medicaid have been changing and have become much stricter. Having long-term care insurance protects you from this crisis situation. So as independent women, we want choices and continuation of lifestyle and flexibility. Having a long-term care insurance is basically a private pool of money that will help pay for care in any setting. It's important to know that 82% of care is in home, the community, and assisted livings, not nursing home care. People want choices. Long-term care will pay for care at home, daycare centers, assisted living, yes, nursing homes, hospice services, international coverage, and actually something called alternative plans of care that might not have been even thought about in the coming years. All plans are portable throughout the U.S. Now, Natalie, we continue with the presentation.
It's important to distinguish between wanting long-term care insurance and qualifying for long-term care insurance. You can't simply purchase long-term care insurance. You must health qualify. Long-term care insurance is medically underwritten. What does that mean? It means that there's an underwriting, and underwriters want to look at conditions that are stable and resolved. Specifically, cancer, heart disease, joint replacement, and osteopenia are all likely insurable conditions if it has been treated successfully and resolved and given a good period of stability. Conditions that are likely uninsurable: significant osteoporosis, diabetes with insulin, MS, Parkinson's, Alzheimer's, multiple TIA or strokes, and metastatic cancer. And we can see from the graph on the right that with age often come chronic diseases of aging, and insurability gets that much more difficult. We like to say most of our clients are going to the Olympics, but what happens when the doctor's records are requested and a face-to-face interview happens, we see decline rates. It's also important to know that younger women who have family medical history with respect to Alzheimer's or any neurological condition are well advised to consider getting educated sooner rather than later. Underwriters are beginning to look at family history in making their underwriting decisions. This is a conversation that is that there's more than meets the eye when we talk about the cost of waiting to buy long-term care insurance. You'll hear a lot of so-called advisors telling people, wait till you're 50, 55, 60 to look into long-term care insurance. While no one knows what the future holds, it is possible you can receive a diagnosis tomorrow that would make somebody ineligible for coverage. Waiting until health fails or a diagnosis is made will result in not being able to purchase long-term care at any price. Paying the entire bill for long-term care services is really the true cost of waiting. Intellectually, it's easy for us to divide between what we want and what we need, and it's certainly easy to procrastinate. How much fun is instant gratification? but allocating resources now will mean you will not be a bag lady. So please plan now and avoid that disaster. You know planning's important, but you're afraid. Is there really a monster under the bed? Well, let's shine a light on it. What's the cost? What do I need to do to help qualify? And what about my spousal or family dynamics? Today's landscape has grown up quite a bit. Long-term care insurance is 25 years old as a product, and we've got what we call four chassis within that spectrum. So much like a car with four wheels and an engine, all long-term care insurance plans do not look alike. Let's take you to four and talk about those highlights. Standalone long-term care plans. This is the traditional, oldest generation of plan. It's a continuous pay, and it's typically the biggest bang for the buck with generous tax incentives and lots of flexibility in the degree of customizable options. State partnership plans are the combination between private insurance and a back-end protection from the state government saying, should you spend down those assets and exhaust that pool of money, you will have protection from the state, no look back, no penalty period. They're not as flexible. There's certain state mandates on how those plans are designed, but certainly it's a consideration when we think about how much pool of money to consider. The newer generation of plan that has grown up most recently in the last 5 or 6 years are what we call linked benefit or asset-based plans. This is the combination of life and long-term care insurance. It's typically a single premium or a limited pay premium that does what it says. It's life and long-term care insurance. So that means that single pool of money can be used for either long-term care insurance or a death benefit, and should you change your mind, there's a return of premium. We like to say colloquially, these are live, die, or change your mind plans. A great fit for those with dormant money or cash value in annuities or life insurance products. I would like to note a very important footnote with respect to linked benefit or asset-based plans in the state of New York. The first 2 years of a spend down, when somebody is receiving long-term care benefit, the pool of money does not compound. So when we have clients with dual residency, it's important to look at not only other carriers, but also other states. And last but not least is life insurance with LTC riders. Now, this is our second best solution for somebody who is unable to qualify for traditional long-term care insurance benefit, because again, underwriters are looking at mortality, long-term diseases of aging. Life insurance looks at morbidity. So sometimes this may be a backdoor into getting some kind of long-term care coverage, but it is not the same. As you can see, the definitions will either reflect a chronic illness rider or a terminal illness rider. It is important to distinguish between the life insurance with LTCs and true long-term care insurance. Point being, whatever plan design, it's important to note that every carrier and every plan has sweet spots for age, gender, marital status, health, medication, state residence, and others. When we compare the costs of buying an insurance policy to otherwise self-insuring or putting the money in a bank account, we'd like to take you through two scenarios. The first scenario, if you look at the chart on the right, is what would you do with $194 if you simply put it in the bank or put $194 in a long-term care insurance policy per month? If you put it in the bank, first bar on your left, after 20 years you would have quote-unquote put away $46,000. If you got a decent return from a bank with 5%, let me know if you find any out there, in 20 years that money would have grown to almost $80,000. If you chose to put $194 from your long-term care insurance premium and bought a long-term care insurance policy and shifted the risk, day one you would have a pool of money of $270,000. And because you wrote in 5% compound inflation to that policy, in 20 years that pool of money would have grown to over $800,000. Close or in line with the kind of money you need 20 years from now, given the rising cost of care. It's also important to note that self-insuring costs you more. Yes, surprisingly it does. Assets have to be liquidated, that represents lost income, and self-funding actually increases the cost of that care, given taxes and opportunity costs. These are the numbers. Assume you need $435,000 to pay for care. At a marginal tax bracket of 25%, we need to liquidate $580,000 to fund $435,000. At a 5% compound rate of return, that $580,000 could have grown to $671,000. That represents opportunity cost. So the cost of self-funding is the cost of care at $435,000, the income tax that we paid of $145,000, the appreciation on the assets we had to liquidate at $91,000, and the total cost of care is $672,000 for care that really cost us $435,000. And if we do the division, the cost for every dollar's worth of care, we have now spent $154 for every dollar's worth of care. If we contrast that to transferring the rest to an insurance policy and paying a premium of $32.30 a year, after 20 years, we would have paid $64,000 for a plan that would give us $250 a day for a 3-year multiplier with 5% protection. In the end, to get $435,000 after paying $64,000 in premium, the cost of care for every dollar's worth of benefit would have been 15 cents. So comparing transferring the risk to an insurance company versus self-insuring, it's very, very easy to see that the numbers support, the economics support this. And this is before tax credits and federal deductions. There are a number of ways to pay for long-term care in addition to simply writing a check. While there are generous tax incentives both from the federal and state government, again, the state government in New York gives us a 20% credit on annual premiums, regardless of premium, regardless of income, and there are generous federal deductions in place for business owners. 1035s can also be used if there's cash value in life or annuity contracts. The message regarding timing will never be better. Long-term care insurance to date has been unisex in pricing. Again, it's a young product, it's 25 years old, and insurance carriers have now caught up with not just actuarial data, but claims data. And they have the numbers show women live longer, women claim later, and women are 2/3 of the claims. Because of that, women's rates are rising. It's also important to note that every state has a guarantee fund, so much like we have SIPC on our brokerage accounts and FDIC insurance on our bank accounts, insurance companies are protected with state guarantee funds. What's the process for long-term care? Simply, it's important to look at health and pre-qualify options. After that, taking an application is a simple yes or no, followed by your doctor's records and, depending on age, a face-to-face interview or a personal health interview. 6 to 10 weeks later, there's an underwriting decision, either approved or denied. If approved, clients can modify policies up or down after approval, and if denied, there's an opportunity to appeal. So the message really is to get educated and don't be a bad lady. Make long-term care insurance planning a priority because something is always better than nothing. Protect your most important assets, your family, your lifestyle, and your independence. Rona and I thank you for the opportunity to speak with you this afternoon, and we welcome your questions.
Thanks, Natalie and Rona. That was really great. And we did have some questions that came in, so I'll get started with this first one here. It is, I have no idea where I'll be living in my later years because I've moved around a lot and have family spread out across the country. Does LTC insurance work in any state?
Yes, LTC insurance is good in any state. It does not matter what state you purchase your long-term care policy from. It is good anywhere in the U.S. And limited international.
Okay, thanks. This other question is, I went through the whole deal of putting my aunt in a nursing home and watching her money disappear. It cost over $12,000 a month in New Jersey. I'm in my 50s and I wonder if a nursing home would take my 401k. I also have dual citizenship in Finland. Is it realistic to just go back to Finland instead?
Well, the reason why that they're taking her, the money is because she's probably on Medicaid being in a nursing home. So we don't know what the laws will be at this point, but long-term care insurance is basically private money to help you pay for care in any setting. So if you had long-term care insurance, you might not have to be in a nursing home. You could probably be at home for a more reasonable cost of care. So again, we're talking about Medicaid laws that will be 20, 30 years out, and again, nobody knows what that'll be, but they are going to be stricter, and they might want to get your 401k. Is it reasonable to go back to Finland to get care? If you're thinking about that, there are some cash plans that are available now for international benefits, and it might be something that you want to think about because the cash type plans are actually going away.
Okay. And do you have time for another question?
Yes,
Sure, we have plenty of time for questions.
Okay. This other question is, I was diagnosed with type 2 diabetes, which is controlled by medication. I also quit smoking 10 years ago. Would I still be able to get long-term care insurance?
Diabetes is a condition that is typically not easy to insure, but I would tell you the likelihood of success depends on other conditions, what we call comorbid conditions. So if we have a good A1C score and it's been stable and there's no other conditions, you are likely insurable.
Okay, great. Thank you. Well, we want to thank you again, Natalie and Rona, for such a great presentation. Long-term care is such an important issue, so we really want to thank you for taking the time today to talk about it. And thank you to everyone who joined us today and asked questions. We hope we'll see you again in the future. Thank you again, Natalie and Rona.
Thank
you so much.